Hey guys, Nate here with Nuview Trust Company. Today we did a little something different. I sat down with our Director of Marketing, Bryan Poss, to talk about what he likes to invest in because not only is he an employee of Nuview Trust Company, but he's also a self-directed IRA investor and has been using a self-directed IRA to invest in startup companies and private equity companies because that's what he understands best. So I sat down with Bryan to talk a little bit about why he invests in private equities and how he does due diligence. Hope you guys enjoy. Bryan, we've just heard news that Peter Thiel, co-founder of PayPal, has got a $5 billion Roth IRA. By investing his Roth IRA in PayPal way back in the day, basically a private equity investment, private entity investment, startup company. You've been investing in startup companies for a long time. What got you to invest in private equities, private entities, or startup companies, and what do you like so much about it?
Sure. So how I initially got started in investing in private equities was prior to coming to Nuview, I worked in the software space for about 18 years, particular software as a service companies. Started a company, sold it to a group of private equity investors, and then I've been involved in a lot of different startups that have gotten their first round of Series A funding, VC funding into the company. So I'm very familiar with the process, I understand it. And just from my knowledge of knowing how venture capital works and technology companies. So one of the things I like about private equity investing is when you look at the current stock market, you look at some of these IPOs that have just recently come out through the NASDAQ or the Dow Jones, the valuations of these companies are ridiculous. They're way over market value, but the market's willing to pay that. With private equities, you don't necessarily have that. So you can get into these companies at a really good time where they're early startup, and you invest $100, $200, that could turn into a $30,000 investment later on once that company goes IPO. So I just don't like investing in companies where they're in the stock market because the valuation is too high. It just doesn't make sense. If there's people out there willing to pay that, great, good for them. But that's why one of the reasons I like self-direction is because you can determine the price that you want to pay for. You're not necessarily dictated by what the market's willing to pay.
So you're using self-direction for truly what it's meant to be, investing in something that you're knowledgeable about. But every investment's risky. What are the risk factors that one should consider before entering into investing in private equities?
Yeah, so some of the risks are, one, you don't know if every company is going to turn into an IPO or if they're going to be sold at some point. You never know how that investment is going to turn out. You could lose all of your money. If you invest $50,000 into a startup, you could lose all that. But there's things you can do that can sort of help with due diligence so that you've done everything possible to make sure that it's a good investment and it's something that you're confident about investing in. There's risk for everything. Like I said, not every private equity investment turns out. Like I've invested in a couple winners, for example, Airbnb, Uber, and then there's some that are real duds that I know aren't going anywhere. So, but again, if you do the due diligence, more than likely that investment's going to turn out for you.
Due diligence. Key word there. With any investment, you got to do due diligence. What do you do for your investments? Without giving investment advice, obviously, what are some of the things you do for the due diligence on the companies that you invest in?
So from a due diligence standpoint, some of the things that I do is I invest in what I know. I understand technology companies. I've been in tech most of my professional career, so I understand technology very well, particularly software companies. And you've even heard from Warren Buffett, one of the best investors of our lifetime. He won't invest in technology companies because he doesn't understand them. He invests things that he understands. So particularly with technology, when I invest and I do my due diligence, one, I get a good feel for what they're offering, what the company does. And there's a lot of things that that company will put out. They'll have investor relationships. They'll do a webinar. Well, they'll actually have a webinar with their executive team and potential investors can go and ask certain questions. They'll put a lot of their financial information up. There's things that I look at is what is their manufacturing cost? What are their sales? If those things are kind of out of line, if their manufacturing costs are way more than their sales, that might be something I might want to shy away from just because the business model is not lining up. There's things that they'll put out like presentations, there's PDFs, you can actually get a feel for their marketing. They'll put a lot of their marketing pieces out there. You can see how well their marketing engine's doing. And then you can kind of see already some of the companies that are already clients. And then when you look at their sales pipeline, some of the actual opportunities that they might have in their sales force of potential companies that they might end up closing. If there's some real big companies in there like Walmart or some companies like a Fortune 500 company in there that's saying, hey, they have a pretty good pipeline of business that they potentially could close. So that kind of just gives you a little bit of the outlook on the potential growth of the company. So there's all kinds of things that you can do to make sure that you're doing the right due diligence to ensure yourself that, hey, I feel good about this investment. This company's got potential. And again, at the end of the day, it may still not work out. Not, like I said, not every investment's going to work out. But if you do the due diligence, most likely that investment's going to turn out for the better than the worse.
Now, I know with private equity, there's different rounds where an investor can participate in. Explain to the audience, what are the different rounds that you see in private equity investments, and when is the best time to invest in a private equity investment?
Yeah, so when it comes to different rounds of investment, when a company's in its early startup, so there's a couple different phases that they go through. One would be the seed round or the angel investment round. And these would be typically family or friends or somebody that they know that has lots of money that they get in early. And then after that, you'll see what's called the Series A Series B, and a Series C. And each one of those rounds is potentially larger money. So initially, that first Series A can be anywhere from $8 to $15 million of capital that's being injected in that company. And that company's still sort of early, I don't want to say early startup, but it's kind of mature, where you might have a VC that sees the potential. They have some KPIs. Maybe they haven't gone international yet. Maybe they're thinking about expanding in international markets. A Series B is just another level where they're developing different product lines. They're looking to expand maybe it's Latin America, maybe it's in Europe. There's just a lot of potential for more revenue and more income. And then Series C would be sort of the last initial round where it would be pretty significant, and kind of the same thing where it's basically taking, how they're going to expand globally sort of to like another level. They might have just been in Europe, but now they're looking to expand into, let's say, Asia. Maybe instead of having 4 different product lines, now they have 10. So there's a lot of different things that they're set up that can actually drive more revenue into the company. So it just really comes down to, what is a company worth? What is the current revenue that it's driving, and what do potential investors see in that will sort of drive those rounds? And really, the best time to get in is as early as possible. The earlier you get in, the better, because your shares over time will get diluted, which is not a bad thing because the valuation of the company goes up over time. So you take, for example, Peter Thiel. He got in pretty early, and his shares probably got diluted over time. But the current valuation of PayPal is so high that he's a billionaire now. Same thing. The earlier you get in, like for example with Uber, I initially invested $200. By the time they went IPO, that turned into roughly about $25,000, $28,000. So, but the reason for that is the valuation of the company goes up over time. So the earlier you get in, the better. Where if you get in later, you're going to pay a much higher price for those shares because you don't have as much time for the company to increase its valuation.
So how do you find your deals, and what tools or systems do you use to locate these deals?
Yeah, there's a lot of different tools out there that I use now. The great thing is technology has come such a long way for investing in private companies and startups. There's tools out there like MicroVentures, WeFunder.com, OurCrowd.com. These are actual websites where people can go and they can see companies that are potentially looking for investment. Either it's a Series A, maybe it's a seed round, but individual investors can go onto these websites and they can see potentially what the offering is. They can break it down by if it's food and beverage, if it's technology, if it's consumer products, if it's manufacturing, if it's energy. So all of these sites will have all the information you need on there to make those investment decisions. They'll have things such as their sales funnel, the companies that are already customers, companies that are already in the actual sales funnel that they potentially have the opportunity to do business with. So every single tool, every single piece of information that you need to make that decision is going to be available on those type of sites, which is great because, again, being a self-directed investor and having that power to make your own decisions, it doesn't get any better than that. It's got literally everything you need to know to make your decision.
So what would be your words of wisdom or your advice to somebody that's just starting out in this, that wants to invest in a startup company? What would be your words to that new person?
Invest in a company or an industry that you're somewhat familiar with. If you're good with technology, if you understand technology, go for technology. If it's energy, like solar vehicles, electric vehicles, if it's graphics cards, if it's processors, semiconductors, whatever it may be, if you understand that industry, if you've got experience in that, go for that. If it's consumer products, let's say food and beverage, particular beverage products. If you've worked in the beverage industries for, say, Pepsi or Coke, invest in that because you understand that. So you already have a leg up. And then also, it all comes down to due diligence. Make sure that you're doing the research, especially now with sites like I mentioned, Micro Ventures, WeFunder. They have everything you need on there to make an investment decision. So if you're seeing things like I mentioned, if their manufacturing costs are much higher than their sales, you might want to shy away from that company. It might not be a good investment. Or if their marketing expenses are completely out of whack with what their revenue is, if they're spending more on marketing than what they're making in sales, they're probably managing the company not the best way. So it all comes down to invest in what you're comfortable with or what you might have knowledge with, and then due diligence. One of the worst things that somebody can do is not making an investment decision at all, because your money does no good just sitting in an IRA, just not doing anything. You're not going to make any money off of that. So you don't want to sit on the sidelines. Sure, there's times to sit on the sidelines, but most of the time, you got to just do something, make the decision, and jump in and just feel comfortable about it. If you do that due diligence, you're going to feel comfortable about making that investment decision. You shouldn't have any sort of remorse or anything like that. If you're feeling remorse over an investment decision that you made in a private equity, you probably didn't do your due diligence.
So if you thought this video was helpful and you'd like more information and education about how self-directed IRAs work and what types of investments you can put within them, check out our website, www.nuviewtrust.com, or subscribe to our YouTube channel, or follow us on Facebook, where we go live every Wednesday with our Wednesday workshops and get notifications so that you can participate in the fun about self-direction.